A very good morning to you, boys and girls. It is, it's only bloody Wednesday the 25th of June. Oh, I'm knackered already, and it's only Wednesday. Just seen the bad news. Hope you're all doing well. Morning, Mr. K. How are you holding up?
Morning, Ryan. Yeah, it's a long week, this one, isn't it?
Yeah.
Feels like we're having 2 days inside one every time, and now with the markets quieting down, perhaps it's even going to seem longer before we reach the end of this one.
Yeah, absolutely. Looking forward to it. And I've got an absolute ton of central bank comments to get through, which, well, on one hand, that's lucky. I was have nothing else to talk about. Right, let's kick off with the Bank of Japan. We had their June summary of opinions out from the last meeting in June. Um, Nothing that we didn't already know. Same old guff that we'd already heard. Not ready to hike. Uncertainty, trade, blah 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 blah. Things moving in the right direction. Not yet. Not there yet. All that sort of guff. But we did have one of the big hawks out afterwards, speaking alone. BOJ's Tamura, saying inflation is tracking stronger than expected and wage momentum is rising. Inflation is on track or somewhat stronger than expected. There's a good chance Japan could reach a sustainable 2% inflation target earlier due to upward price risks. And he advocates raising rates in a timely and appropriate manner, avoiding premature or delayed action. All sounding very hawkish thus far. Saying need to normalise JGB holdings as fast as we can too, but then says unlikely to hike while trade talks are underway. So 2 steps forward, 1 step back with that one. Anything you picked out from the summary of opinions? Okay.
Uh, Not really. Not really. Um, just leaving the door open, I guess, and see how it goes. But there was nothing really new in there, right?
No, absolutely not. Nothing we already didn't know. Right, coming over to a bit of data. We had Aussie CPI out overnight. Their weighted mean thingy for May coming in at 2.1%, so a little bit softer than expected. Also, one of their other trimmed means coming in at 2.4% versus 2.8% previously. So softer inflation for May over there in Down Underland. We had also BOE's Green coming out and speaking, saying that underlying activity is weak. The labour market has loosened further and disinflationary process continues. Wasn't one of the voters, though, for a cut at the BOE meeting last week, but sounding dovish there at the start. So she's worried about both demand and supply side of the economy. Noisy data means that it will take longer for me to take comfort from recent disinflationary trends. So becoming undovish with that comment. And then tops it off by saying a careful and gradual approach to removing monetary policy restrictiveness continues to be warranted. BOE's Ramsden, he was one that voted for a cut last week, says I now attach more weight to downside risks to inflation in the medium term. Says the June decision was finally balanced for him, which, as he voted for a cut, means that he was also maybe on the cusp of not voting for a cut, which was less dovish, obviously. It says even at 4% rates, I assess that monetary policy would remain clearly in restrictive territory. That was actually something I discussed with his nibs, Mr. Brown, on the trade-off this week. That even if they did do a little cut at the last meeting, it wouldn't make that much of a difference. It might have made a bit of easing difference for the economy over the summer, but it would have kept them restrictive. But I guess they want to be left behind the curve and then have to play catch up at a faster pace later on. We did get the big boss man out as well, Bailey, saying wage settlements are likely to come off. The path of rates is downwards and will continue to be so. Says QT review will be interesting this year because of a steepening of the yield curve. ECB's De Gimpos says coming to day trading now. Iran situation is an extra layer of uncertainty. Well, we're over all that now, apparently. It says the ECB must remain especially prudent amid such uncertainty. Data out from Canada. If I can find it, there we go. We had CPI data out from there, and headline CPI coming in unchanged at 1.7%. The Bank of Canada main core number coming in also unchanged at 2.5%. But we had some of the other measures like this one just ticking up a pip over last month. Some of the others coming in as expected, down a pip. So inflation's been a bit up of the last couple of readings, but it's looking like it's staying a bit sticky over there in Canada. No change to a July rate cut.
No.
It is staying at 38%. But yeah, as their disinflation blip ended in Canada?
It's probably the pass-through we are waiting whether there will be a pass-through of prices and into the pricing from eventual tariffs and things like that. It looks to me very much like a pause of indecision before we know whether it's going to go up or continue back down. So sticky, yes, but I'd just say pause. I don't think we can make any decision of numbers that we are seeing now until we will exactly know who is going to be paying what and how much all this thing will cost. In the meantime, they're also beefing up their own potentials and stuff. And it's going to be, especially when you're so close. And maybe Canada and Mexico is a different ball game, but especially Canada with the US, I think we are in a period here of uncertainty, whether we have to know, whether we don't know what's going to be the next phase, and that phase may actually still continue months. So we may see a bit of those flat readings, or really not far from expectations, or from the prior ones. I mean, just continuing for a while. That's how I look at it, at least right now.
Yeah, absolutely. Wait and see mode, just like all the central banks. We had the US Philly Fed Services Index out that came in at -25 versus -41.9 previously, so less crap than it was before. Then we had some house price data from Case-Shiller and from the FHFA number. Prices coming down, both on the month and price gains easing on the year as well. The FHFA number coming in at 3% year on year versus 3.9% prior. The 20-city Case-Shiller coming in at 3.4% versus 4.1%. The national HPI coming in at 2.72% from a prior 3.37%. So easing of house price rises is becoming a bit of a trend now, and those monthly numbers coming in negative more and more. Doesn't mean things are heading for a cliff, but it just shows that people are maybe getting a bit stretched, and if they haven't got the money to pay up for housing, you're going to see prices coming down as supply increases, which the housing market can be a very good weather vane for whether there are issues in the economy, because obviously it is a high price sector, if you like. So if people haven't got the money for all that, then it starts to maybe send wobbles into other things. That might have been confirmed a little bit by the consumer confidence data that we got out as well, which came in softer. Was expected to go up to 99.4, but actually went down to 93, and the underlying metrics also looking a bit softer as well. Current conditions dropping to 129.1 from a prior 135.50. Expectations came in at 69 versus a prior 73.6. Inflation expectations also dropping to 6% from 6.4%. So we had seen a little bit of positivity in this data over the last couple of months after it went a bit wonky, or 1 month anyway. Now it's gone back to going soft again. So still looks like the consumer is not yet a fully happy bunny, but we're not too far off some of these high levels. So we're not falling off a cliff anywhere just yet, but the trend is what you need to watch. Did you pick up anything from that data, mate?
I'm going to say the same thing as with the Canadian CPI. The consumer is also on pause.
Yeah, everyone's on pause.
Yeah, but I mean, is it not really that, Ryan? I mean, everybody's now waiting for what's going to happen next, right? But we've also always been saying the same thing. The consumer is extremely important for the Fed. So get another weak number on top of this one, the next one, and then things may all of a sudden snowball a little bit for expectations for maybe not an immediate cut, but at least turning even more dovish.
Yeah, absolutely. And we're in month 2 of my 3-month window that I saw that, or I see that if we're going to see any reaction from any of this stuff, it's going to start feeding through. We've already seen the weaker sentiment data not appearing in the hard data, but you look for the little signals like in house prices, consumer confidence, other metrics, and the US isn't heading to a recession, but are there still going to be some wobbles to come? We're in the window. We shall see. If it doesn't happen, then anyone who's getting bearish over the US may have to eat a bit of humble pie.
Yeah.
And that'll be the trade to come. So everyone's still waiting for the US to roll over. If it doesn't and gets all uncertainty, then the opposite is likely, because we'll see a bit of a bounce on that positivity. How long that lasts, though, is another question, probably for next year. But we're all forward looking here, mate.
Especially that we saw those housing starts, on the other hand, being a pretty solid number on Monday. So it's not yet a done thing that the US is falling off a cliff. But again, we do need to wait to see what's really going to happen. Especially also we're talking about that so often on the shows and and in our chat room. That we still need to see effects of in the jobs market as well, which may have to wait until August, September, even. The second half of the year is going to be extremely important for, I think, the global US picture. And as you say, it's holding up, then we are going to have, or some people, me included, perhaps, we will have to revise our opinion on the dollar, maybe.
Yeah, absolutely. And we're getting there. This August-September period where we like to see those government jobs coming in. I think it might set up for one hell of an NFP trade. If we get a real, negative NFP down 200,000 or something, but all of that is in the government payrolls, you're going to see the market initially dump dollars and then probably reverse it once everyone goes, oh yeah, we were waiting for that, and it won't be a surprise. So I think it could be fun, those NFPs August, September, but plenty to go under the bridge before we get there. Morning, Mark. Have I declared victory on my bet with Mr. Brown on the SPOOs? No, not yet. He clarified that I said the all-time highs. It needs to make a new all-time high. I thought it was 6,100, but that geezer likes to bend and break rules as he sees fit. But no, the bet is still ongoing. Hoping it get resolved sooner rather than later. Fed's Bostic says that there's no need to cut rates now, but sees a single 25 pip cut late this year. Fed's Hamak says rate policy could be on hold for quite some time as the Fed seeks further clarity. Doesn't see any imminent case to cut interest rates. Would rather be slow and right than fast and wrong with monetary policy. Fed's Williams, monetary policy is very well positioned. Collins, the current state of monetary policy is necessary. Cash and Carry says the Fed is in wait and see mode to get more clarity on the tariff effect on inflation. It's possible the Fed could cut rates when inflation is still high if the labour market deteriorates sharply, but that's not a scenario he sees happening anyway. Fed's bar policy well positioned to wait and see. Fed Schmidt, wait and see approach appropriate. Policy should reflect economic conditions. So just before I go on to Powell's waffling, Kay, it seems all the non-Trump fans are come out to speak against Waller and Bowman so far.
Yeah. The games have started. Have started at the Fed, at the FOMC. It's that's what we can expect. I think we are not done yet. There may be some more divergence upcoming, especially if those two come back and affirm what they have been saying. I'm not sure whether when the next time is that Waller or Bowman are speaking. But yep, more divergence at the Fed, it seems. Yeah.
Yeah, exactly. Right, on to Powell. And what a shit show that was. Some of the questions, it beggars belief how these people get into roles of power as politicians. But, well, same could be said everywhere for that. Anyway, Powell said we could see inflation coming in not as strong as we expect. And if that's the case, that would suggest cutting sooner. Also, a weaker labour market would suggest cutting sooner. But then he countered that by saying if inflation and the labour market is strong, we could cut later. Said a significant majority of policymakers feels it will be appropriate to reduce rates later this year. So the reasons we are not cutting rates is that forecasts in and out of the Fed expect a meaningful increase in inflation this year. I think we will start to see more of a tariff inflation impact starting from June. Overall, Kay, the market sort of took some of his comments as dovish, but that was probably how it goes. It was in responses to questions, so it wasn't exactly the party line, and it was all ifs, buts, and maybes. Could happen, might happen, whatever. But no real change from him there. But I get the sense that the reason he's been so stubborn on keeping rates is because he's shit scared of getting into the same mistake with inflation that they did last time.
Yeah, and it could be seen as political. I mean, he did leave a door ajar, saying that changes may come rapidly or not, but changes may come rapidly in the sense that the next set of data can take them over the line to go more dovish. In that sense, he gave in a little bit, but he spent 3.5 hours of the 4 just saying exactly the same as he was saying before. We don't know. We have to wait for confirmation.
Yeah, absolutely. So, and we get to do it all over again today. I've booked a hair appointment, by the way, for
maybe maybe we are not maybe we are not going to stay tuned in for such a long time. But yesterday was one of the best soaps I ever witnessed on that Humphrey Hawkins testimony. It was quite crazy, the people who are there, and the questions that were asked, and the way that the questions were asked. It was absolutely hilarious.
Yeah, and the woman who turned up with her baby as well.
Exactly, that was the cherry.
Yeah,
Little
bonkers.
Sam.
Yeah, kids in the workplace. There you go. Who knew it? Right, there's not much else to blather on about. We've got this NATO stuff going on, in which NATO's Rutte has been kissing Donald Ring, in terms of some of the comments he put out this morning about getting everyone to this 5% defence spending commitment, of which Spain is still up in arms about it. It's not a veto they've got some exception or whatever. Trump has taken a pot shot there, saying Spain is a problem when it comes to NATO spending. Some of the other bods as well, Rubio, I think, singling out Spain for a bit of grief. But long story short, maybe they're all going to toe the line and agree to this increase to 5% of GDP spending on defence, or putting into the NATO pot. No doubt there'll be bells, whistles, and conditions, and we'll do it over the next 3 million years or something. Anyway, that's about all we've got to come out from that side of things. Have you got any data today? I haven't even checked. What do we got? That building permits is a revision, but we've got new home sales. So there we go. Another look at that. What was it? What did you mention, mate?
No, yeah, the oils afterwards. But what do we have here last night on the API? I'm trying to scroll back. Another little draw. Okay, maybe not going to change much. I mean, those data are, let's say, important when there's not a lot going on. But since we had about 15-20% moves up and down on war situations, I don't think that barring a blip, maybe a buck or so up or down, they are going to have too much of an impact unless we get like really very outsized data.
Yeah, exactly. Yeah, Rob covered that Oz CPI at the top of the show. A little bit softer from those guys. So yeah, that's it from that. Right, let's get stuck into what's going on in markets, and not having a good week on the old scalping front. I was long 145s yesterday down into the zone and got stopped out on the other side, and here we are sailing up towards 146 again. And well, I don't know what's going on with this yen. It's up, it's down, it's up, it's down. I think we still, as I mentioned, the reason why I took along at 145 is that I thought we would keep going in this momentum that we saw prior to all the Iran-Israel stuff. That might be the case now, but I think we might just be in a bit of waffle mode right now, not knowing whether we want to go up or down or wherever. So still a bit of volatility in this one. So expect some good two-way action. Get a headline. We'll be back down again. You got any read on this one, mate?
Yeah, I updated this morning. There's a bit going on my side in those low 144s. Longer and more medium term, but risk is still keeping it from falling further. That move up in the 148s ran into an interesting zone. So I guess taking into account volatility, we should range in the dollar yen, in my opinion, just because there's not too much reason for it to fall out of bed. Unless the yen crosses turn around. And as we see, the yen crosses in general are still holding up relatively well. So that is something that in turn could be supportive for the dollar yen. And then I know and maybe still a bit early, but yesterday we saw, in my opinion, the premises of some month-end dealings as well. People will have noted, and we are going to show it in a minute, what's happened in the Swiss franc. And it's like at around that time, or a little bit afterwards, the dollar yen also had its acceleration to the downside. So are we starting to see those flows? Because I really don't want to draw all the attention to it, but we do have month, quarterly, and half year end, right, this month. So we may see the start of all this hedging against what they need to do, or hedging or balancing their FX neutral books a little earlier. We know that a lot of people start early these days, and to prevent from causing too big waves on the last day of the month, and maybe just that, but in general, I think the yen pairs are still pretty well supported. So the dollar move, yes, but I think we are going to see a bit of support just because of those crosses.
Yeah, no, absolutely. I know I joked about it yesterday, talking about the end of the month, but yeah, this This is one of the big ones. Month ends can be fairly big. Quarter ends can be bigger, but when you get to the half year and year ends, they can really be a doozy. We can really see a lot of action going on. So keep an eye on the clock around the hourly mark. If you get any funky moves suddenly out of nowhere, then you know it's likely fix action, and no doubt that will step up. And what's it looking like? I mean, it's not as if it hasn't been a volatile first half of the year for everyone to deal with.
It's been very volatile, Ryan, and I've been looking from afar, not really into details just as yet, but I have seen discrepancies between what's happening on the monthly and then what's happened on quarterly and half year. So it could really get a bit funky, this one. So far, the short term, the monthlies are calling for a little bit of dollar selling, but I've seen really quite big divergences in stuff like euro, for instance, where over the past 6 months the European bourses have outperformed even the US. If you look at the DAX, for instance, is year to date up 17%, where the S&P year to date is up a mere 1.5%. Just to give those kind of examples, and so I think there may be a bit of a surprise or a big mess coming up for the half year end. And yeah, it may be a difficult one to really call, but I'm going to say if I look at crosses and stuff like that, I may suspect the euro may be a little on the weak side versus some crosses, but on the tip of my toes.
Yeah, it's certainly going to be. We're going to need to watch what goes on at these fixed points, because it can just as if we
give opportunities, huh?
Yeah, give us opportunities, but it can
Yeah.
also just muddy the waters even more, because you start
Yes.
seeing the euro getting sold for 3 days on the trot, and everyone goes, "Oh, that's the end of the rally. It's all done. We need to be short and chase it lower." And then after we get over the into the new month, it gets back on the train, and everyone gets caught out at the bottom.
And that is what I think how we have to look at it. If you're a day trader, get out of the way and wait for it to happen, and then that may give you an opportunity if the fixings were contrary to the overall move that we are seeing running into these days of fixing flows. And that's how I usually look at it, and how some of us trade it in the rooms as well. Okay, if it's obvious, you can trade with the flow, but then don't forget to take your profits when come around 4 p.m. London time. That's you do either or, but the safest way to look at it is, if you're in a longer term position and or a more medium term position, and the fixing goes massively your way, it's perhaps time to also take partial profits on your more medium term position, because we could have a pretty big snapback once the fixings are over. If it goes against what's been happening, it could be that long termers are just sitting on their hands and waiting for everything to be over, and then massively go the other way around again. So I mean, it gives opportunities, but in the meantime, be very careful, because your tech levels will mean very little. People who need to rebalance their books, FX neutral funds, sovereign wealth managers, asset managers, they don't give a damn about where the trend line is. Huh? They just do their stuff, and that is it.
Yeah, and that's the way to do it. If you see a sharp move, find out why. Find out why it's moving. We know. I say we know. We will have a good idea in our chat room. If something sharp happens, we can look at the clues pretty quickly to say, okay, this was a fix, or this was a headline, or this was something else, or that even we don't know what it is. And if you see those types of moves, either take profit from it if you're the right side, as Kay says, or if you're the wrong side, don't get the hump. See what happens. You can always get back in. But another benefit of being in our chat room, we can usually find out why a move is happening pretty quickly, and from that you can make your trading decision. And perhaps for the euro, that's, you're saying maybe seeing the euro a bit weaker. It's had every opportunity to crack this high and kick on, but it hasn't. There may be some barrier interest going on, as I mentioned previously, between every 50 pips up to 120. But it could also be this month end stuff, Kay. So this will, I think, be a good clue. There's no reason why the euro shouldn't continue going, based on everything we know as to why it's been rising thus far. So if it can't, and there's no headlines behind it, no data behind it, nothing behind it, then again, that's your clue. Maybe we're seeing some month end stuff. So if you weren't on the long side and want to be, and you're waiting for a dip, you might get that, as long as you try and understand it. What are you making of the euro this far, mate? Could we be
So
setting up
far,
a bit of range, trading, bit of consolidation, maybe, or is
yeah,
it all in the air?
I think the Israel Iran thing has kind of be potentially probably digested because we have seen those moves. I would say, yeah, the really shorter market may now be waiting a little bit. We still see globally a positive equity market, yields a tad on the defensive, which should be supportive for risk. That's why I'm thinking those yen pairs could just continue to be supported. Um, uh, all else equal, and yeah, I mean, I think the euro can consolidate a little bit right now. And again, I mean, it's not taking into account any potential early month, quarter, or half year end flows. Um, but for the rest, yeah, I think we may need a bit of consolidation. Let the data tell us a bit. We got a bit of data coming on for tomorrow and on Friday, I think.
Yeah.
Let the data tell us where we need to be, potentially even after month end, and then we'll pick it up again where we left everything. That's how I look at it anyway. And also, you're talking about the euro. I think a lot of the other pairs have been doing roughly the same thing. Um, on at their own speeds, because we also see exactly we got a bit of an overshoot on the prior high in the cable, and coming back down to the big figure right now, 136. Needs perhaps a little consolidation too. We've seen the same thing. The Aussie tried higher, Kiwi tried higher, Dollar Cat tried lower. The cat is a different animal, but yeah, we've seen a lot of things being unwound, and now we need some fresh impetus.
Yeah, that cat's looking a bit interesting.
Yeah,
Seems
I
like
mean
it's
that was
quite a high.
really came out of nothing really special on the CPI, and then all of a sudden it turned around pretty massively. I was saying that there was some support down to 136.40-ish. We didn't go all the way down there, but the jump was quite yeah, quite thorough.
Yeah, yeah. I wonder if he's setting up for me old 1, 2, 3 pattern, which people might say is a precursor to a head and shoulders there. So yeah, little test and hold, maybe up to 40, 45 that holds. I might have a little nibble short on that one, see if the pattern plays out. Um, Mark, if your account doesn't net out, do you ever use sell and buy stops instead of stop losses? I
The
don't
problem
know.
the problem is, Mark, that you're going to create fresh positions if you're not netting out.
Yeah,
Uh, if you do buy stop, sell stop instead of stop losses on existing positions.
yeah, you're just
You,
locking in whatever loss or profit you've made.
yeah, the thing is, maybe Mark is saying, like, for instance, you're long €1 dollar, and you only say, I want to have a partial stop. Then if you don't net out, then you're going to have to use individual stop entries on your position. But You need a really good housekeeping system then, Mark, to keep track if you start to do that with several positions. If it's only one position and you slice it up, then okay-ish, but that's complicating stuff. But I know it's an issue. I've had a couple of books that I ran and which I couldn't net out either, and it's a bit of a headache in the end, I must say.
Yeah, it's a bit of work if like Kay says, if you're going long some and then you're setting a sell stop for part of that thing. The easiest way to do it is if you're going with orders, okay, then you can split your orders up. You can put in multiple orders as long as you're not subject to crappy American rules. Which is what I do sometimes. If I'm going to buy against a level, I'll maybe put in 2 or 3 orders that I can set the same stop to, but I can set different profits targets to. And I do that a lot when I do stop entries. So like Aussie dollar, um, I've got buy stops above the highs, and I've got several in. So I've got one in that will automatically take profit 20 pips through, and just in case I get a quick spike that then reverses and I don't have time to do it manually, then I can let that trade go for 20 pips, and that's my first slice, if you like. And then you can do that. That's okay doing it with orders, having multiple orders in. It's a bit more difficult if you're trading at market. You either have to suck up and do 1, 2, 3 trades, and whatever price you get at the time is whatever you get, and factor that in, so you can do the same thing. But otherwise, if you start taking reverse trades as a partial net off, then you're going to have to faff around getting out both sides to realize that profit or whatever.
And
And then you
pay more brokerage.
pay more brokerage, exactly, and losing maybe pips on the spread or whatever. So yeah, make life easy for you. But I get where you're coming from, Mark, and well, I think we get where you're coming from. If we don't, then let us know in the chat room. Right, Kay, I'm going to push it over to you, mate. And just going on what Ali's saying there, we are simultaneously reviewing charts. You find that we've pretty much got the same sort of line, same sort of view. Yeah, Kay uses some other stuff, uses a lot of trend lines and whatever compared to me, but you find that a lot of us all come around to the same sort of lines or areas a lot, which shows we're all watching the same pictures, really.
And I would like to add that we are, and you're still not with us, Ali, but we are talking about stuff day in, day out in our chat room, and so most of the views that we express on our show have already been discussed in the chat room, so we know what we are talking about, and we can easily comment off each other's chats because we are used to see each other's chats as well. And I just want to reply to you, Ali, on your dollar yen. You're long at 145 and a bit with a stop. Where are you? Where's your stop? You say? Where is it? 44.92. 44.92. I don't really have anything specific. Maybe you're looking on the shorter term. I just wanted to show this confluence of little bits, the demand or no lines that I had done in that 144. And I think we are in this big range. We went very close to my resistance box the other day and shied away. So that tells me that we are still in a big range. But I want to show, and I know that Derej is always very happy when I show gold if he's around. Look where we stopped. We stopped on the second defense line. I told you yesterday about this 32.90 that there was more consolidation potentially to come. That's what happened, and we bounced off it. So this is your interesting level of the day, okay? To stretch it to 90, 32.90. This is where you have to watch what's happening on gold today. Over time, this trend line is obviously going up, and I will take it out because I don't like it when trend lines come to market too quickly. Then I'm moved back onto the actual support level, which has been previously tested and traded. But again, it's been interesting that 32.90. Okay, and top side 33.40. I think that we are a bit like the rest, and we've spoken about it. A bit like the rest, we are in digestion mode, or the digestion is coming to an end. So now we wait for something new to happen. 33.40, but I would still argue that 33.70, 75 is going to be a bigger resistance area here in gold. So 33.40 may be your little hinge of the day if gold decides to rally further. Otherwise, I think we're in a $50 or so consolidation zone, 32.90, 33.40, until further developments. This is how I look at it. Um, I wanted to look at something. Oh yes, that dollar Swiss. So yesterday, I said this 81.55 is pretty important. It was very big, and multiple support area. It's broken down. We need to redraw things a little bit because this is looking still very heavy. This dollar Swiss, and that was despite better risk overall. So that means, and then we saw this acceleration. Euro Swiss all of a sudden started to trade much lower, and I reckon that may be remains to be confirmed, obviously, during the European afternoons, but that may mean that we see the start of some month-end, half-year-end stuff in the Swiss. If we look around the spectrum, yeah, I would rather say Swiss has a bigger chance to be bought than sold over month-end again, but needs to be confirmed. Now, if we get back above 80-90, that may in turn confirm that this low that we saw here in April, that we revisited yesterday, has become a very tradable low. So the jury is out here, but 80-90 first indication, but really we need to start to move crack back above those prior levels to say this is reversing, which I think may be the possibility once month end is over. Um, in the meantime, if things gets worse or we need to buy more or there is more Swiss franc to be bought, we can only trade shorter term on extensions because the last time we went at these levels, if we start to break those levels, is really um, after the GFC and into the European crisis. So we don't have much to hang on to in terms of target levels on the dollar Swiss. Perhaps 79.70 and then 79.20 or so, your next levels on the downside. But be very careful because what happened yesterday in the Swissy was really counterintuitive because it was despite all else trading quite risk positive. Okay, we have seen the sterling, which is a risk currency, doing pretty well. We had seen those Aussie and the Kiwi doing pretty well, and yet the Swiss franc strengthened, which is really not what we are used to see when the risk is trading positively. Euro Swiss as well. It's starting to look dangerous. We had yet another attempt on this 94 and a quarter, 94.30, and dropped away pretty significantly. We went down to very close to the triangle support. If that breaks, we're probably going to change big figures again, but all of it can be really month end, half year end. Okay, so keep a very close eye on what's happening in the next few sessions, because that may be, as we were just talking about, may be a brilliant opportunity. If that is the reason why we are going down on all the Swiss pairs, that may be a brilliant opportunity come month end, maybe even on Friday, but latest next Monday or so. All right. Um, 146 big level on the dollar yen. It's been traversed so often of late that I don't see it as a big level. I don't see it, Ali, as a big level on the dollar yen anymore. The 146, but some people may have a different opinion. Yeah, the euro. We quickly looked above those prior highs, now shying away. I think we. Ryan, did you see anything specific on these couple of days on the option front around 116? Because it looks like we are magneting a little bit there.
No, nothing
Okay.
really. No, not at all.
Okay, all right, because it does look like we are stabilizing, maybe just the market taking a breather. But we're stabilizing around 116. I'd say whatever happens here, if the dollar needs to consolidate, we need to allow for some breathing space, okay? So I wouldn't even be surprised. I wouldn't be surprised we get that back down to 115.70 or even 115 and a half, without really changing the overall picture. I still think we are getting ready sooner or later to have a crack at it and then have a look into that 117 zone. I need to go on the wider ones. Yeah, up to that 117 zone. And I really think that we are on our way to at least get up there in steps, but we need to wait. Um, yeah, for the rest, I'm not going to show too much. I know that Ryan, myself, again, back into a bit of dollar mix. I still think that the global picture hasn't changed. We just had a bit of a stop run above this zone here, but it reversed relatively quickly. Um, Keep an eye on those levels here. Maybe 1890s already, but especially down to 82 in the dollar mix. If ever we start to get back down there, I think 18 and a half is just going to be the next stop. But global picture hasn't changed. I think the nervosity may start if we start to break above that 35.42 zone. That is, or 35.45. That's where I think people will get more nervous. The longer term carry traders, perhaps. I think with that, Ryan, for today at least, I'm going to give it back to you, mate. There's really not a lot more to say, I think.
Yeah, thank you very much, mate. Good stuff as always. Even if you've got not a lot to say, it's still good. Thank you, everyone, for coming to the Flow Show as normal. Have a great day. Try not to fall asleep in front of power later, and we shall see you all tomorrow. Toodles.